Imagine being a 45-year-old single mom, raising 2 kids after losing your husband. You've managed your finances well, nearly paid off your house, and built a future for your children. Then, a $270,000 investment from your husband's life insurance, put into the stock market during the COVID downturn, grows to $1.1 million. Instead of joy, you feel anxiety. What now? Do you risk it for more, or protect what you have? This isn't just about numbers, it's about your family's future and honoring your husband's legacy. Let's break down how to turn this windfall into lasting security. In 2020, the world was in chaos. The pandemic had brought life to a standstill, and uncertainty loomed large. Streets were deserted, people were confined to their homes, and the financial markets were in turmoil. Amidst this global crisis, personal tragedies were unfolding in countless households. This mom, newly widowed, took a leap and invested her husband's life insurance, $270,000, into the stock market. It was a bold move, driven by a mix of desperation and hope. She knew the risks but felt she had little to lose. The future of her family depended on this decision. She picked about 20 stocks. Hours turned into days as she researched, analyzed, and finally made her choices. She diversified her investments, hoping to spread the risk. It was a daunting task, but she was determined to make it work. Most did okay, but 4 soared, including Palantir. These stocks defied the odds and skyrocketed, bringing in returns she had never imagined. It was a mix of careful planning and sheer luck. Fast forward to today, her investment is now $1.1 million. The initial $270,000 had grown exponentially, transforming her financial situation. It was a remarkable turnaround, a beacon of hope in an otherwise dark time. It's a story of risk and reward, but also of luck, catching lightning in a bottle. The stock market is unpredictable, and her success was as much about timing as it was about strategy. She had managed to navigate the storm and come out stronger. But hitting the jackpot once doesn't make you a pro. The stock market is a fickle beast, and past success doesn't guarantee future gains. She knew she couldn't rest on her laurels. The real challenge? Managing this money wisely, not gambling it away. She needed to make informed decisions, seek professional advice, and plan for the long term. It was about securing her family's future, not chasing another lucky break. Her next move will determine if this windfall becomes a legacy or a lost opportunity. It was a pivotal moment, one that required careful thought and planning. She had the chance to turn this fortune into something lasting. It's time to secure the win, not chase another lucky break. The journey from grief to unexpected gains had been arduous, but now the focus was on stability and security. It was about building a legacy that would endure for generations. Crossing the $1 million mark changed everything. Excitement turned to anxiety. Every market dip feels like a threat to her family's future. She's debt-free, with Social Security income and a nearly paid-off house. This money isn't for daily survival. It's for retirement, college, and peace of mind. The job of this money has changed. It's not about fast growth anymore, but about protection and steady gains. Her gut says it's time to move from risky bets to a safer plan. You wouldn't drive your kids to school in a race car, don't risk your future on a few stocks. It's time for a safer, more reliable vehicle. Don't put all your eggs in one basket. It's a saying we've all heard, but it's especially important when it comes to your financial future. Imagine spending years building up your nest egg, only to risk it all by relying on just a few investments. The temptation is real. When a handful of stocks are soaring, it's easy to believe they'll keep climbing forever. But history tells a different story. Right now, most of her $1.1 million is tied to just 4 stocks. That means her entire financial future is riding on the performance of a tiny slice of the market. If even one of those companies stumbles, the impact could be devastating. That's not diversification, it's concentration, and it's risky. Concentration can feel rewarding when things are going well, but it leaves you exposed to sudden shocks. The market can turn on a dime, and what once looked like a sure bet can quickly become a source of stress and regret. Even big, safe companies can crash. No business is immune to unexpected events. Scandals, economic downturns, or disruptive new technologies can wipe out years of growth in a matter of days. Just look at the headlines from past market crashes. Household names have fallen before, and they will again. One bad quarter, and years of gains can vanish. It doesn't matter how strong a company seems. Earnings misses, regulatory changes, or global events can send stock prices plummeting overnight. The pain of watching your hard-earned savings evaporate is something no one should have to experience. I've seen people lose hundreds of thousands right before retirement because they bet too much on one company. The regret is real, and the consequences can last a lifetime. When you're close to retirement, there's little time to recover from a major loss. Protecting your wealth becomes more important than chasing the next big win. Diversification is ancient wisdom and smart strategy. For centuries, people have known that spreading your investments across different assets is the best way to guard against the unknown. It's not about avoiding risk altogether. It's about managing it wisely, so no single setback can derail your plans. Your fortune shouldn't depend on a handful of CEOs or tech trends. No matter how brilliant a leader or how innovative a company, the future is unpredictable. By putting all your trust in a few names, you're gambling with your future and your family's security. The goal now isn't to get richer fast. It's to stay rich and secure your family's future. True wealth is about peace of mind, knowing that your loved ones are protected no matter what the market does. It's about building a legacy that lasts, not just chasing the next big thing. Spread your risk, build a solid foundation, and protect what you've earned. Diversification gives you the freedom to weather storms and seize opportunities without putting everything on the line. It's the cornerstone of lasting financial security. That's how you turn a windfall into lasting wealth. By making smart choices today, you ensure your prosperity endures for generations to come. The first step, sell the stocks. All of them. Cash out, take the win, and get off the roller coaster. Yes, you'll owe taxes, maybe $80,000, but that's the price of success, not a penalty. Don't let fear of taxes keep you in a risky game. After taxes, you'll have over $1 million, safe and ready for your family's future. This is your chance to move from speculator to investor. Secure the win, set aside the tax money, and breathe easy. Now, let's put that money to work the smart way. Where should your million go? Imagine you've just come into a significant sum of money. Maybe it's a windfall, a bonus, or years of hard work finally paying off. The question now is, how do you make this money work for you? Not just today, but for years to come. The answer isn't always obvious, and the stakes are high. You want growth, but you also want to protect what you've earned. Not back into a few stocks, but spread across hundreds through mutual funds. Instead of putting all your eggs in one basket, mutual funds allow you to invest in a broad mix of companies, industries, and even countries. This way, your money isn't tied to the fate of just a handful of businesses. It's a smarter, more balanced approach to investing. Mutual funds pool money from many investors to buy a wide range of companies. Think of it as joining forces with thousands of other people, each contributing a little, so together you can own a piece of something much bigger than you could afford alone. This collective power gives you access to professional management and a diversified portfolio. It's like owning a piece of a huge apartment complex instead of one risky rental. If one tenant moves out, you still have dozens of others paying rent. In the same way, if one company in your mutual fund struggles, the others can help balance things out, keeping your investment on track. If one company stumbles, your whole future isn't at risk. This safety net is what makes mutual funds so appealing to both new and experienced investors. You don't have to worry about the daily ups and downs of a single stock. Instead, you can focus on the bigger picture, growing your wealth over time. This is diversification in action, steady, patient growth, not wild swings. Like a tree that grows a little taller each year, your investments can build gradually, weathering storms and thriving in good seasons. It's about progress, not gambling. Mutual funds let you benefit from the market's long-term rise without betting everything on a few names. Over decades, markets have shown a tendency to grow, despite short-term setbacks. By staying invested in a mutual fund, you can ride out the bumps and participate in that upward journey, all while enjoying the peace of mind that comes from broad diversification. You've had your lucky break. Now it's time for a proven, steady approach. Investing isn't about chasing the next big thing or hoping for a quick win. It's about building a foundation for your future, using strategies that have stood the test of time. Mutual funds offer that foundation, managed by experts who understand the markets and work to grow your money responsibly. Wealth built little by little is wealth that lasts. The most successful investors know that slow and steady wins the race. By consistently adding to your mutual fund investments, you harness the power of compounding, where your money earns returns, and those returns earn even more. Mutual funds are your vehicle for that journey. They offer a simple, accessible way to grow your wealth, protect your future, and reach your financial goals, one step at a time. Building a diversified portfolio is simple. Use the 4-fund blueprint. Divide your investment evenly among 4 types of mutual funds: growth and income, growth, aggressive growth, and international. Growth and income funds invest in big, stable U.S. companies, your portfolio's foundation. Growth funds target large U.S. companies still expanding. Aggressive growth funds focus on smaller, high-potential companies. International funds invest in major companies outside the U.S. With this mix, you own pieces of hundreds of companies worldwide. This strategy turns your windfall into a wealth engine for generations. With a diversified mutual fund portfolio, your future is predictable and secure. Historically, the market averages about 10% returns per year. At that rate, your million could double every 7 years. In 7 years, $2 million. In 14, $4 million. In 21, $8 million. You can pay for college, retire comfortably, and help your kids, all without gambling. No more daily stress over stock swings. Your money grows quietly in the background. This is the power of steady, disciplined investing. You can finally relax knowing your family's future is safe. This mom's journey, from loss to $1 million windfall, is remarkable. But the real victory is what she does next. She can keep gambling, or she can secure her family's future with a proven plan. Selling, paying taxes, and investing in mutual funds transforms anxiety into peace. True wealth isn't about luck. It's about discipline and a solid strategy. Her late husband wanted security, not stress. By making this change, she honors his legacy and builds a foundation for her children. That's the greatest return on investment of all.